Hey everybody, welcome to Money's No Object. I'm your host, Dylan Howell. This is episode number 293 of our YouTube channel and podcast, and I cannot be more excited to continue sharing with you guys personal finance topics that I think could be useful for you in your long-term financial journey. Today, we are going to be talking to those in the same age cohort as myself. I'm talking to you 20-somethings, right? And I'm going to talk about investing in your 20s, because I know that this is one of the areas where we have been least educated, right? And it's one of the more daunting areas if you don't know anything about it. It's one of the areas that we need to be paying attention to, even though many 20-somethings are asleep at the wheel when it comes to investing, and those who are trying to invest may not be doing so in the best way possible. So I'm going to give you some tips as to how you can effectively invest in your 20s and how you can become a better investor as you move forward in your long-term financial journey. So stick around for all that and more in today's episode. Before we get started though, if you could go down below, hit the big red subscribe button, like this video, leave me any feedback in the comments down below, and I'll be sure to respond to anything you leave down there. If you're listening on Apple or Spotify podcasts, be sure to subscribe and leave me a review on either one of those platforms. Follow me on social media at MNO with Dylan, and that's really good supplemental materials to all the things I'm putting out in these long form episodes on YouTube and the podcast every single day. And then if you need somebody to help you to build a financial plan and keep you accountable to that plan over the long term, then I can do that. Just DM me on any of the major social media sites and tell me that you are interested in financial coaching sessions, and you and I can begin working together, pushing towards your long-term financial goals and ultimately pushing you on towards long-term financial freedom, which is what I hope for every single individual watching or listening to this show on a day-to-day basis. Now, if you're in your 20s, I know there are a lot of things on your mind, especially when it comes to your finances, right? You're out on your own, likely. That is, if you're not still living with your parents, but you're likely out on your own. You're paying rent, or maybe you have a mortgage. You might have a new child like me and my wife do, or, you might have student loan debt, or you might have any number of things that just seem to be a hindrance to your ability to invest for the long term, and seem to be a hindrance to your ability to move forward in your investing life, right? There's so many things that are just on our minds and just weighing us down and seem like they're just never-ending new things when it comes to our adulting, right? And so we have to look at these things in the face. We have to deal with them, obviously, but we still have to push into our investing life one way or the other. And no matter if you're 20 or 29, right, the advice I'm going to give you today is it's going to be useful, right? These tips are going to be useful. These tips are going to be things that you can apply to your everyday life and that you can take with you, especially once you start investing. Now, something I want to begin this episode with, just as a reminder, is that all of this is within the scope of the financial action plan. As much as I want you to invest as early as possible and as much as early as possible as you can, right, then I don't want you to be deviating from the financial action plan. I don't want you to deviate from the particular steps, the particular order in which you should be doing things in your financial life, because deviating from this can lead you into some financial peril. So as we go through these different tips that I'm going to give you, I'm going to frame them in the way of the financial action plan, not just in the way of you should be doing this right now, no matter what. Okay, so let's just jump right in. Let's jump right into the first tip that I have for you. And the first tip I have for you is to accept your employer's generosity. Now, what does that mean, right? Well, if you're in your 20s, especially if you're out of school already and you have a job, right, then your job probably offers some type of employer-sponsored retirement account. Most jobs do, whether it's a 401k or a 403b, or you work for the government, it's a TSP, whatever, right? They likely offer some type of employer-sponsored retirement account. And a lot of those who do offer those types of accounts also offer an employer match. And you've heard me talk a lot about the employer match if you've watched this show for any particular period of time, right? And what I want you to be doing, if you're in your 20s, is at the baseline, when it comes to your investing, you should be taking the match. You should be taking the match in your 401k, 403b, TSP, whatever's offered to you, because this is 100% return free money, right? You get immediate 100% return. So the way that most of these matches work are, it's like 4%, right? 4% of your income. So whatever you make, 4% of the gross amount, not the net of taxes or net of insurance amount, but of the gross amount, right? If you can put that amount into your 401k, 403b, whatever, right, then your employer will also put that amount into your account. And in doing so, you immediately got a 100% return, which is fantastic, right? This is great. We would like 100% returns immediately. Now, this is why this particular part of the financial action plan is on its own from the other parts of investing, right? I tell you in the financial action plan, you need to have a unique monthly budget. You need to have 1 month worth of expenses set aside for emergencies as a beginner emergency fund. Then the third part of the financial action plan is take the match if it's offered to you. Now, I don't want you to invest any further than that until you get through the fourth and fifth part of the financial action plan, which are, we pay off all our non-mortgage debt, right? All our non-mortgage consumer debt. And then the fifth part being building up an emergency fund that is 4 to 6 months of expenses to where, hey, this is a fully funded emergency fund. Then we can get on with investing even more, right? But I do want you to be taking advantage of the employer's generosity, them giving you free money, right? It's hard to leave free money on the table. And people say, oh, it's not free money because you have to put money in too. That's partially true, right? But ultimately, you are getting money for doing something that you should be doing anyway. You are getting money that you wouldn't have gotten otherwise, okay? It'd be like somebody saying, hey, if you go and you buy this car, I'll buy you another car, the exact same car. Sounds like a pretty good deal, right? Or if you go and buy this house, I'll buy you another house that's exactly like this house. In all of these situations, these sound like amazing propositions, right? And it is the exact same when it comes to the 401k. They are offering you the match. They are offering you a certain percentage of your salary in a match. So take up to the match in that third part, then no more until you get out of debt and you have a fully funded emergency fund. Then we can move into some more specific investing tips. But you should be accepting your employer's generosity because you're never going to get returns like that again. And the more that you can build up early on, because that's the thing. If you're just putting 4% of your salary, right? Let's say you're putting 4% away, or let's say 5, right? 5 is an easier number by which to do math, right? So if you make $50,000 a year, okay, and you have a 5% match, okay, over the course of the year, that's $2,500. Okay, that means that you put in $2,500, your employer puts in $2,500. Okay, that's not a ton when it comes to the full course of the year. That's just right over $200 a month that you're putting in, right? But you double that, and that becomes over $400 a month that is going into your retirement accounts, and that is really going to compound well for you over a long period of time. So taking advantage of the match early on is absolutely huge. So that's the first tip I have for 20-somethings when it comes to your investing is take the match. Take advantage of the match, okay? The second tip that I have for you is to make risk your friend. Now let me pause. This does not mean that I want you to be pure speculation in your 20s. You know, if you've listened to this show at all, I have no problem with you speculating some. I have no problem with you taking 10% of your portfolio as long as you have an adequate size portfolio. And I say that means having at least like $10,000 in some traditional investments, right? As long as you have that, you can take 10% of your portfolio and have it as, Jim Cramer calls it your mad money, right? You can speculate in things. You can trade in things. Now, you can obviously buy individual stocks if that's something you feel the proclivity to do, right? I want you to do that if you have the mindset, the temperament, and the knowledge in order to do so. But if not, then you can ultimately take the easy road and not be far too risky with your investments. You can buy index funds. You can do those types of things. But ultimately, in your 20s, making risk your friend is a good thing, right? This doesn't mean going out and YOLOing all your money on cryptocurrency. This doesn't mean going out and stacking money into meme stocks that you know nothing about, like AMC and GameStop and all the rest, right? That's not what I'm saying. What I am saying is that you can take more risk even in traditional investments than others can. So what does this look like? So if you buy individual stocks, this may mean buying stocks that don't have the longest term of track records, right? Of earnings or of revenues or whatever. Maybe they're higher growth companies. Maybe you have looked at these companies, you've done the analysis. It seems to be a good investment, right? But maybe it's still pretty high risk as far as the size of the company or the age of the company, very young or very small companies, right? You can buy into things like that. And even if you lose money on those types of things in your 20s, then you can still bounce back pretty quickly. Not to mention, if you're just taking, let's say, an indexing approach, right, where you're buying indexes every month, maybe you're just putting money into your 401k or IRA or whatever, right, you can diversify into things that have a little more risk. You don't have to be all S&P 500, right? You can diversify into mid caps and small caps and international companies and things like that. Or even more so in making risk your friend, right? This may mean don't hold anything in fixed income in your 20s, right? I don't understand why a 20-year-old or 29-year-old for that matter would need money in fixed income. It does not make any type of sense to me. Now, you may believe something different. That's your prerogative, right? I'm just telling you, I am going to be 100% equities probably forever, probably over the long term. I just don't foresee bonds being a place that I want to hold my money when I know what I can make in equities over the long term. Okay. But in your 20s, the equities that you hold can be a bit more risky than, the equities held by a 40 or 50-year-old, right? You can hold equities that have a little more variability in price, right, that are a little smaller, a little less known, but in order to make good returns down the road. But ultimately, what we're doing here, we still want to be long-term investors. We still want to think long-term, but your allocation here can be a little more towards the volatile because you have time and you have the ability to take the volatility in stride. And that's something you need to learn in your 20s, is to take the volatility in stride. You need to learn to, when the market is up or down or whatever, right, that you can just continue on with your investing strategy. You don't change things just because the market does what the market is going to do over a long period of time. So make risk your friend, be willing to do so, and understand that you have a long time horizon. So there's no reason to freak out. There's no reason to trade. There's no reason to over speculate, but you can take risks that other people can't because you have more time and the ability to do so. And that can teach you a lot about the market, and it can allow you to make some really, really good returns in your 20s as well. Then the third tip that I have for you is that you should keep it simple with index funds or ETFs. Okay. Now, like I said a little while ago, I don't think you should be doing any speculating until you have like $10,000 in traditional investments. When I talk about traditional investments, I'm talking about stocks, bonds, mutual funds, ETFs, things like that, right? Now, within mutual funds and ETFs, we have index funds, right? And then we have ETFs that can also be in the form of index ETFs, right? And I think, and I've told you this many, many times, and I will, keep hitting this point until I'm done with this show, which is no time soon, right? That index funds are probably the best way to go for most individuals who try to invest, simply because if you don't know much about investing, they're easy, right? They're simple. They're simple to understand. Okay, and if you don't know what an index fund is, I'm about to tell you. All an index fund is it is a particular index, right? Meaning it tracks certain types of companies within the stock market, or certain securities within the stock market, certain stocks, certain bonds, certain whatever, right? It is just a tracking mechanism. That's all the index is. Okay, so an index fund is just a fund that tracks the index. So the most popular of which is the S&P 500 index, which is approximately the 500 largest companies in the United States, most profitable companies in the United States, right? This is U.S. large cap equities, large cap companies. So this would be a type of index fund because it tracks the S&P 500. And in doing so, if you own this index fund, then whatever returns that the index makes are going to be the returns that you get, right? So it's very simple to understand what you're invested in. Right? It's very, very simple, very easy. And this is many of the largest companies that you've always heard about, especially in the S&P 500, your Apples, your Googles, your Facebooks, Netflix, Amazons, all these different companies, right? I've left plenty out, but there are tons of companies in there that you have heard of, that you use every day, that you know what they are. And it's far more simple and low cost to diversify and keep your money somewhere where it can grow sustainably over a long period of time, right? And that is somewhere where money has grown sustainably over a long period of time. That's why I use index funds a lot, right? A lot of mine and my wife's retirement money is in index funds. Now, that doesn't mean I don't buy individual stocks, because I do, but I still think that most individuals, most of your money should be in index funds because it is so simple, it is so straightforward, and you can get more predictable returns over time. And if nothing else, right, you're not rolling the dice and seeing if you can try to beat the market. You just get whatever the market gives you, which is perfectly fine given that the long-term rates of return on the market have been quite good. Now, that doesn't mean they'll be the same in the future, but if the past tells us anything, it can give us some indication as to what we should be looking forward to as we move forward. And especially when we're talking about some of the largest and most innovative companies in the world, I think it's worth doing. Now, keeping it this simple it is going to take away from some of your ability to make these big outsized returns, but it's also going to take away your ability to be dumb and lose out on returns that could have been easy within an index. Okay, so I think this is very necessary. I think this is something that a lot of individuals need to take advantage of. Now, that's just the idea of index funds, but I also think that ETFs need to be talked about a little bit because ETFs are very tax efficient, right? ETFs, these are exchange traded funds. So they are just mutual funds. So these index funds, right? You can get the ETF version, and all the ETF version means that you can trade them intraday. It's not, buying from a mutual company directly. What you're doing is you're buying and selling shares from other investors, from other, let's say, institutions or individuals, and that decreases your tax liability over time because the mutual company's not having to, cash out certain gains and things that would end up being taxable events for you over time. So ETFs, they can be very useful. They can be more tax efficient. And so those should be taken advantage of as well. And you can get index ETFs, so you can kill two birds with one stone there. The only downside to ETFs is that some companies like Vanguard, they'll make you buy the entire share of the ETF, which doesn't sound like such a negative thing, but companies like Fidelity and maybe even Charles Schwab, some others, I know for sure Fidelity does it. You can buy partial shares of ETFs. So no matter what amount of money you put into the ETF month after month, you'll buy that amount of the ETF. You won't have money just sitting in cash because it didn't buy a full share. Okay, so index funds and ETFs, keep it simple, invest in those. Okay, then the fourth tip that I have for you investing wise is to get help managing your money or learn about managing your money. Okay. Now, I am not suggesting that every one of you out there goes out and gets a financial advisor and pays them 1.5% a year from now into oblivion. That is not what I'm suggesting, especially in your 20s. In your 20s, right? Any money that you give away is money that is not going to be growing and compounding for you over a long period of time. Okay. And when I say give away, I'm saying whatever you pay to an advisor, right? If you pay money to an advisor, then that's money that's not going to be growing and compounding for you over a long period of time. Now, is it worth it to get it right? Yes, it's 100% worth it to get it right. But let me tell you this, it's far easier to get it right than it has ever been, right? Or let me just say this, it's far easier to not get it wrong than it's ever been. If nothing else, you hear somebody like myself talk about investing in index funds and you go and you open an account and you just pour money into index funds for the next 30, 40 years, right? You're going to be exorbitantly wealthy if you invest aggressively. You 100% will be, and it wouldn't have required an advisor to tell you anything. It just would have required you actually acting and going out and doing that for yourself. Now, this is not to say this is the 100% best way to minimize taxes and 100% best way to maximize returns over a long period of time. That's not what I'm saying. But what I'm saying is you cannot get it wrong by just learning some very basic things and doing it yourself. So I 100% implore you, not just watching this show, but watching and listening to all different types of opinions and views that are congruent with the idea of long-term investing, right? And learning as many things as you can, reading books, being very open-minded as to what is going on around you, and then finding the best thing, finding the thing that has proven to work over a long period of time and doing that, right? And emulating that. That will be what's best for you over the long term with your money. Now, if you are a little lazier, then maybe you should have an advisor that keeps you on your P's and Q's. But don't have an advisor that's just going to take over and manage your money for you, right? You are ultimately the manager of your money. Your advisor, if you have one, is not the manager of your money. They are the person that you have appointed to teach you how to manage your money. And so you should call all the shots. They should not be the ones calling all the shots. They work for you, not the other way around. You should be making all these calls. And so ultimately, you do need to learn about your finances. You do need to learn how to manage your money and invest properly. And then once you learn whether or not you feel comfortable with an advisor, that's 100% up to you. But I think for most 20-somethings, right, the advisor's only going to be a hindrance to your ability to build wealth over a long period of time. Because ultimately, we don't have a ton of money in investment accounts anyway. Right? And not having a ton of money is going to hinder their ability to invest our money maybe in the way that they want to, right? Because a lot of advisors, they limit to, certain balances that they'll take. Not only is that the case, you end up, you're giving away 1.5%, 2% to an advisor. And that will, in a very real way, eat away at your ability to make gains over a long period of time if you remain with said advisor. Now, it doesn't mean that you won't make better returns, right? But that means that the advisor would have to beat the market for you if they're doing something actively managed. They would have to beat the market for you by, whatever that amount is, 1.5%, 2% max, right? In order to just break even with the market in your accounts. And that's not what I want for you over a long period of time. I think you can learn enough in order to do it yourself. You just have to be very diligent and do your research and understand things as best you can. I do it myself. Now, I do have a lot of formal education in finance, so that may be a different thing. Right, but a lot of what I learned about personal finance was on my own, and then some on-the-job training as an investment advisor representative. And I know a lot of people don't have those same experiences, but that doesn't mean that you can't read. That doesn't mean that you can't watch shows like this. It doesn't mean that you can't look up other YouTube channels that teach you similar things, right? So ultimately, you might need a little oversight. You might need a little help, but getting the education is going to be the most valuable thing for you over a long period of time because it will persist. It will maintain with you, and you'll be able to, even if you have an advisor, keep your advisor on their P's and Q's and make sure that they're not doing any funny business with your money over the time that you have that money with them, okay? Then, the fifth and final tip that I have for you guys today when it comes to investing in your 20s is to incrementally raise your savings rate, okay? I tell all 20-somethings, start small, okay? I know it's difficult to start. It's definitely difficult to start investing when you've never really put money away in that way before, right? So you should 100% start small, 100% start with small amounts until you get more and more comfortable, okay? But do not fail to increase the amount that you're contributing over time. Now, I tell you in the financial action plan, when you're investing in part 6, you're out of debt, you have a fully funded emergency fund. I tell you 15% or more of your take-home pay that you should be investing. Now, some people may not feel comfortable with that amount. I think you should get there ultimately. I think you should work your way there. But ultimately, you should be putting away some substantial amount of your income in investing every single month. And as you get raises, right, as you decrease expenses, as you get out of debt, as you do all these types of things, you should be incrementally raising your savings rate, right? Because I tell you, I say get out of debt, I tell you to take the company match. So that means you already have some savings rate that you have established there. Maybe it's 4%. Right? But then you get out of debt and you build an emergency fund, and then now you can increase that savings rate. You can incrementally increase the amount that you're investing, and you absolutely should, because now you have more residual income to be investing. Therefore, you should increase the amount that you're saving. But every time that you get a raise, every single time you get a raise, naturally, whatever percent you may be putting into your 401k, 403b, whatever, if you have one, is going to remain that percent. But it's going to be a higher amount of money if you make more money now. So that will increase there, right? But you should also increase it in other places like your IRAs, your brokerage accounts, and things of the like. Okay, you should continue to increase your savings rate. Don't be decreasing your savings rate unless you just went overboard, unless you tried to get too aggressive with the way you were saving. Then you might have to back it down just a little. But ultimately, you should be just stepping it up every single chance you get, because what happens over a long period of time is the more money you can put away in your 20s, that money is going to have far more growth on it than any other money that you put away later on. Okay, so any little amount you can increase here, right, will be worth a lot more later. And not to mention the number one variable that says you are going to have a good retirement, that you're going to have money in your retirement accounts, that you're actually going to be a successful retirement saver. The number one variable that says that is going to be the case is savings rate. Okay, so if we know that that's the case, then increasing our savings rate should be very, very important to us. It should be important to us to know that, hey, the more we save, the more we're going to have, obviously. Right? So make that a priority in your life. Understand that, yes, as you make more money, you should be enjoying more of it. You should be giving more of it, but you should also be saving and investing more of it. Okay, we shouldn't just be spending everything residual that we have or any new money that we get, right? We should be doing our 3 uses of money that I've talked about time and time again on the show. We should be saving, which includes investing, spending, right? So we should enjoy some of our money, and we should be giving, right? We should be doing all those things in certain proportions that are congruent with our lifestyle and beliefs, and it should be a balance. We should be balanced in the way that we use our money, but we have to make sure that that balance includes investing, because if it does not, then you're not likely to get to where you need to be over a long period of time. Ultimately, I just want you to work your way up in little jumps, right? When you get a raise, increase it. When you get a little windfall of money, a tax return or whatever, right? A stimulus check, then just toss that in there. You get the child tax credit money back. Toss a little bit of that in there, right? Any extra money that you have, be throwing it in there in your 20s, because it's going to be so valuable to you over a long period of time. Ultimately, every $1 that you put away today in your 20s, right, if you get a 10% rate of return over the next 40 years, will be worth $45.26 40 years from now. Okay, so that may not sound like much, right? Oh, okay, $45.26. That doesn't sound like it's going to sustain me very much. But let's say that you put away $500, right? You put away $500, that's $22,629.63 40 years from now. Now you see the importance. Now you see how big these values can get. And obviously, if you're putting away $1,000 now in 40 years can be over $45,000 that you have, right? That is a huge value. And then if you say, okay, 40 years is a long time though, 30 years from now, right? Any dollar that you put away can be worth $17.45, right? So again, if you're putting away $500 today, right, that can be worth $8,724.70 30 years from now. Okay, these dollar bills that you put away today are so valuable. So you have to be increasing the amount that you invest. You have to be investing aggressively if at all possible. But again, work through the financial action plan. Get yourself a strong financial foundation before you get into any of these places. Okay, go ahead and be budgeting, right? Have a plan. Know where your money's going. Track your expenses, all those things, right? Get to a place where you have a month's worth of expenses set aside. Start taking the employer match. And obviously that goes along with the first tip that I had for you, which was take advantage of your employer's generosity, right? Take the employer match. Then get out of consumer debt. Okay, 100%. Get out of consumer debt other than your home, other than any mortgage debt that you may have. Then build up a fully funded emergency fund of 4 to 6 months of expenses, because let's say you lose a job, 4 to 6 months of household expenses may be what you need to bridge the gap until you can get another job or something of the like, right? It is a rainy day fund. It is money that is there to take care of you. It's insurance against tragedy. Okay. And then you can start investing aggressively for your future. And then past that, right, while we're investing aggressively for our future, we want to be working on paying off our home faster, right? We go past that. If we pay off our home, okay, let's get to a point where we're maxing everything out, right? We're maxing out everything that we can with our income because we have so much residual income now. And then ultimately, we want to be extremely generous. We want to give away as much money as we can. We want to be generous with our time, with our abilities, but ultimately our finances as well, because that is a true sign of somebody who is content with what they have and who has built something up from nothing and can appreciate the fact that they have done so and want to help others. Okay, so overall, I know your 20s are stressful. I know your 20s bring a lot of questions and bring a lot of ambiguity into your life, but I want you to understand that investing in your 20s is so vital, and I want to help you to do that. I want to help you to do that in an effective way, and hopefully these tips can help. Hopefully these tips can get you to a place where you can be an effective investor over a long period of time. So let me just remind you of the 5 real quick before we go. So you want to accept your employer's generosity, meaning take your 401k match or whatever match you have available to you. Make risk your friend, right? So you can take a little more risk in your 20s, a little more volatility, variability, and make more returns. Keep it simple with index funds or ETFs, right? Some of the best ways to invest over the long term, right? And be as tax efficient as possible. Then get help managing your money. Learn as much about your money and investing as you can, right? And maybe even use an advisor if that is necessary for you. And then incrementally raise your savings rate, because savings rate is going to be directly correlated with the amount of money you end up having when you retire. Okay, so hopefully all those things help and can help you to be a better investor over a long period of time, because they are surely working on me, and they are surely things that I'm putting into place every single day, and hopefully you can too. So thanks for watching this video. If you could go down below, hit the big red subscribe button, like this video, leave me any feedback in the comments down below, and I'll be sure to respond to anything you leave down there. If you're listening on Apple or Spotify podcast, be sure to subscribe and leave me a review on either one of those platforms. Follow me on social media at MNO with Dylan, and that's really good supplemental materials to all the things I'm putting out in these long form episodes on YouTube and the podcast every single day. And then if you need somebody to help you to build a financial plan and keep you accountable to that plan over the long term, then I can do that. Just DM me on any of the major social media sites and tell me that you are interested in financial coaching sessions, and you and I can begin working together, pushing towards your long-term financial goals and ultimately pushing you on towards long-term financial freedom, which is what I hope for every single individual who's watching or listening to this show on a day-to-day basis. So tune in tomorrow as I continue talking about personal finance topics that I think could be useful for you in your long-term financial journey. So thanks for tuning into this episode of Money's No Object. I'm your host, Dylan Howell. God bless.